So what are some of the tax benefits of a C corporation? Let's talk about it, because the first major decision you must make once you decide to start a business is, what kind of business entity should I create? Should it be a sole proprietorship, single member LLC, S corporation? So today I'm going to look at why you may want to start a C corporation, starting with benefit number one, liability protection. Now, corporations are seen to have the strongest protection when it comes to personal liability for its owners, directors, shareholders, officers, and even their employees, because the corporation is considered to be its own separate entity and completely separate from the individuals who work within it. So in this way, any legal obligations of the business cannot become personal obligations associated with the individuals of the company. For example, if the corporation becomes insolvent and faces bankruptcy, then the debt obligation would have no effect on the personal financial position of its shareholders and their respective credit score, but instead only the corporation's finances and business credit would be impacted. Now, of course, we've talked about how you get a similar advantage when you establish an LLC or a limited liability company as well, because with an LLC, the entity is also separate from the individual, which provides a legal shield for the business owners. But there are still many advantages of a C corporation that exist over an LLC. So in this video, what I want to do is cover how a C corporation works, look at the advantages of a C corporation, like just having that entity in place, and then look at the tax benefits of a C corporation as well, with calculations and examples along the way. So if all that sounds good to you, then please consider lending a helping hand by liking this video while the intro plays. Hey there, and welcome to our channel. I'm Sean with Life Accounting, the accounting company that helps you save on taxes and build more wealth. And look, if you love the sound of that, then make sure you subscribe so you stay in the loop for all our future videos. All right, before we talk about all the fantastic benefits of a C corporation, let's take a quick step back and talk about number two. What is a C corporation anyway? So a C corporation is also referred to as a C-Corp, and it's a type of legal entity structure that people can choose from when they're setting up a business. The way that I view C corporations from other entities is that C corporations can totally stand on their own because they have their own unique tax rate, their own unique credit score, their own unique regulations, and so on. It's almost like a C corporation is an entirely different person in an entirely different world. Hey Sean, look, I can be a C corporation. Okay, so you get the point. Now, it's important to note that a corporation is often viewed to be a little bit more complicated because their structure has a lot of moving parts than other structures like an LLC, because a corporation is divided into three parties, okay? You have the shareholders, who are the investors and owners that hold stock in the corporation. Then you have the board of directors, who are engaged in long-term strategic planning. And then lastly, you have the officers, who are engaged in the day-to-day operations. So you can think of people like the CEO, CFO, CTO, and so on. Now, it's entirely possible and common for one person to participate in some of those positions or all of them. Now, the final thing you should understand about C corporations are that they are taxed at the entity level, meaning that C corps must file their own tax return and pay their own taxes on any profits that the corporation made, which is a big difference when compared to LLCs, which are pass-through entities, meaning that the profits are passed through to the owners. Therefore, the owners must pay taxes on any profits or distributions within their individual tax return. Okay, we're going to talk about taxes a little bit more in depth in the third part of this video. But now that you understand what a C Corp is and how it is structured, let's go ahead and get into number two and look at the specific advantages of a C corporation. And I'm going to highlight how some of these advantages would differ from other legal entity structures, such as the LLC. Now, one advantage we already talked about in the intro, which was liability protection. So that's important to note because I'm not going to go through that one again. The next big advantage you should know about when it comes to C corporations is that they have a strong ability to raise more capital. And that's because there are I repeat, no limitations on the number of shareholders that a C Corp can have or sell, which is completely different from other legal entity structures because, for example, when you have a sole proprietorship, well, they cannot even have outside shareholders outside of the primary owner, right? And so then when it comes to partnerships or multi-member LLCs, the shareholders are limited to the owners of the business, the general partners and the limited partners of the LLC. Now, when you elect to have your LLC to be taxed as an S corporation, then you are allowed to have outside shareholders. However, you are limited to 100 shareholders. Now, I have to admit, 100 shareholders is still a very sizable amount for most small businesses. But there still is a limit that we must acknowledge. For example, if you have 100 shareholders and each shareholder contributes $10,000, that would give your business $1 million in capital, which may be great initially. But what if you had another 100 people who wanted to contribute $10,000? Well, in that case, you would not be able to do that under an S corporation. Whereas with a C corporation, there is no shareholder caps, thus you have unlimited growth capital potential. And this is why in most cases, investors love to invest in C corporations because a C corporation is pretty much already set up to issue stock, and they can have different classes of shares and stocks, which can incentivize other investors like venture capitalists. The next great advantage of establishing a C corporation is its innate ability to have perpetual existence. And that's because of how a C corporation is structured. The company can continue even as shareholders, directors, or officers come and go, which again makes investors very happy because they know their money is safe and more stable as they don't need to worry about something damaging happening to the owner. Now, this is a stark contrast when compared to other pass-through entities like a sole proprietorship or general partnerships, because those entities dissolve once an owner has entered retirement or decides to quit or dies or faces severe bankruptcy. So with all of these advantages, you can probably see how C corporations have a major advantage when it comes to raising capital. So if your business requires capital to grow and you need investors, then a C corporation would likely be an attractive option for you. Now, I should note, a C corporation makes the process easier for investors, but having a C corporation does not make getting investments or raising capital or finding investors any easier, because you still have to put in effort to find investors. Okay, let's move on to the third part of this video and talk about the tax benefits of a C corporation, starting with number one, a strategic tax rate. So here's the deal. In 2018, a tax reform bill was passed that lowered the corporate tax rate from a range of 15 to 35% to a flat 21%. Okay, corporations pay a flat 21% on any profits made, which is much lower when you compare that to the upper range of pass-through entities and individuals who can be taxed up to 37%, which for 2022 will be anyone who earned more than $539,901. For example, if you had a C Corp that had $600,000 in profit, it would pay $126,000 in taxes. Whereas if you had an LLC that had $600,000 in profit, the owner could pay $222,000 in taxes, which is almost a $100,000 difference by simply changing your legal entity. Now, of course, we're playing with some big numbers here, but what's more interesting is that the flat 21% tax rate is still lower than the 22% tax bracket, which applies to anyone who earns between $41,776 to $89,075 for the 2022 tax year. So great, right? Like, everyone should have a C corporation. Well, not exactly, okay? Many entrepreneurs and small business owners steer clear of a C corporation because of what is known as double taxation. Because remember, C corporations are taxed at the entity level, but eventually as a shareholder or an owner, you want to get paid. And when you do, you will receive dividend income, and that is something that you will report on your personal tax return and pay taxes on. So if you have a C corporation, then you're being taxed twice, okay? One time at the entity level, and then again when you get paid dividends as a shareholder of the corporation. Whereas owners of LLCs or other pass-through entities are only taxed one time on any profits made. And this is what makes the decision to become a C corporation for tax purposes much more nuanced and strategic, because if your company is making enough money to put you in the 24 to 32% tax bracket and you don't need to take distributions or you don't need dividends as income, then that means you're able to leave the money inside of your C corporation to maybe continue reinvesting into your company. And if those reinvestments pay off to help your company grow, then you're essentially holding an asset that helps you save on taxes and build more wealth. And this is what many large corporations do, like Amazon or the owner Jeff Bezos, right? They use this tax strategy to pay very little tax rates. So they're using their C corporation to shift or delay their income for future company growth. Which, by the way, if you need help with taxes, then please check out the first link down in the description below, where we help you develop a tax plan and help you get your questions answered. Okay, now I know that was a lot, but it is very important. So I would recommend rewatching that a couple more times if you need more clarity, because that is a key tax benefit of a C corporation. Or if you comment within the first 24 hours of this video being published, then I'll try to answer as many questions as I can. All right, let's go ahead and move on to tax benefit number 2, writing off charitable contributions. C corporations are the only business entity that can deduct charitable contributions as a business expense, which is awesome. But there is one caveat, which is that contributions to a charitable organization cannot be no more than 10% of the taxable income for that corporation within a given year. However, even with this limitation, they can still carry forward that charitable deduction for the next 5 years. Whereas with LLCs and S corporation owners, they must take charitable contribution deductions on their personal tax return inside of the Schedule A. So if you've ever wondered why corporations are so incentivized to partner with nonprofit organizations and sponsor events, now you know. Moving along to tax benefit number 3, writing off salaries and taxes. So shareholders of C corporations can also serve as officers or other W-2 employees of the corporation, which allows you as the owner to get paid without worrying about double taxation occurring on the profits. Now, these W-2 wages are still subject to payroll taxes, but the corporation can deduct the wages and the share of payroll taxes against the corporation's taxable income, which is a great tax deduction. But the real key here is that the company can pay employees enough salaries so that there is no taxable income that remains within the corporation. Within reason, of course, because the IRS does want the salaries to correspond to the services that the shareholders provide to the corporations. Whereas with an LLC, the default rules do not allow owners to consider themselves to be employees, thus they cannot take salaries or these same tax deductions. All right, moving along to tax benefit number 3, carrying profits and losses. Okay, so there are 2 big things that come with this tax benefit. The first is that C corporations can determine their physical tax year, which allows shareholders to be able to shift income more easily. Because with this flexibility, you are allowed to determine what year you want to pay taxes on and when you want to take losses, which can also help you reduce your overall tax liability, which is much different from LLCs and S corporations whose physical year must coincide with the calendar year. So a C corporation can have a physical year of April 1st, 2022 to April 1st, 2023, whereas LLCs by default have a calendar year from January 1st to December 31st. But why does this even matter? Well, let's say, for example, you have a snow plowing company that usually makes the bulk of their revenue during the winter months of, let's say, November to March. Well, splitting revenue between January 1st to December 31st would adhere to a calendar year, but at the same time, it would make obtaining a solid picture of the company's financial positions and performance a lot more difficult. So a fiscal year would be a more appropriate measure of the company's success. Now, LLCs can have a fiscal year as well, but usually they must be approved first by the IRS. The second big thing when it comes to carry forwards is that C corporations can carry forward losses without much scrutiny from the IRS. And this is because it is not unusual for C corporations to run at a loss from making initial investments and continuing to reinvest, whereas long-term losses for pass-through entities are definitely seen to be a little bit more sketch, as not too many owners can continue to operate at a loss. Okay, tax benefit number 4 would be deducting 100% medical premiums and fringe benefits. Okay, so offering fringe benefits is a great tactic to attract and retain employees. And for C corporations, fringe benefits can be 100% deductible while also given tax-free to the employee, as long as the company makes fringe benefits equally available to all employees and not just the shareholders. This ends up being a wash for other entities like LLCs taxed as S corporations, because the shareholder must declare fringe benefits as income. Now, the types of fringe benefits that can be offered to shareholders and employees would be stuff like health and dental plans, long-term care insurance, medical reimbursement plans, group term life insurance, and disability insurance, all of which employees crave in a stable work opportunity. So if your C corporation is in need of finding and keeping great talent, then these fringe benefits make for great tax benefits. Okay, now before I wrap up, I have one very important note, which is that C corporations have, of course, a lot of great advantages and benefits. However, they do require more administration, more setup time, and thus they have a higher overall cost. For example, C corporations are required to have corporate bylaws, elect a board of directors, and then hold board meetings, hold shareholder meetings, and issues stocks and shares, which are things that sole proprietorships, general partnerships, and LLCs do not have to worry about. So, of course, think very carefully before just jumping in and setting up a C corporation. Overall, I would strongly look at a C corporation over other structures like an LLC if you are anticipating a need of raising a lot of capital, along with an anticipation of earning a lot of profit, at least $400,000 per year. But for the vast majority of new entrepreneurs and startups, they can get off to a fast and solid start with other entities as well. All right, that's it for now. I hope you enjoyed this entire breakdown. Coming up next, I have 2 more videos that you may enjoy as well. So make sure you check those out if you haven't already, and I'll see you over there.